Alrighty, so the economic outlook. We always have a bit of a theme when we talk about economy every few months or so, and the theme this time is kind of turning the corner, because we think the economy is turning a bit of a corner now and coming on the improve. We always try to select a little picture here to kind of give you a feel for sort of what we mean by that. Very nice road, very relaxing kind of picture. Going off around the corner, can't quite see what's around there, which is life, unfortunately. But also, interestingly, there's this big threatening looking volcano type structure up in the back there, and it's no prizes for guessing who that volcano might represent in the current kind of like economic outlook. So I think the theme there is one of optimism for the future, but also a few risks to kind of look at on the horizon. So in terms of like where this economy has been, well, where it has been last year was in a pretty rough place. We ended up with a couple of very negative quarters of GDP in the middle of last year. So economic growth has been negative in annual terms for the last year. The unemployment rate's been heading up. Generally, most measures of consumer spending and sentiment have been pretty weak for a while. What it looks like to us is that the bottom of the economy probably really was closer to the middle of last year, maybe around July or so. Most of the big indicators of the economy really started to take a bit of a dive from about April or so. But since then, the Reserve Bank started cutting rates. We got some tax cuts late July, if you noticed the amount in your bank account, quite small. But has generally been associated with an improvement in most indicators since then, but just coming from a pretty weak level. And what I generally say is that growth has now returned now. We can actually see that we actually did have positive growth in the fourth quarter of last year, which was a little bit better than we kind of expected, to be honest, before that data came out a week or so. But it is quite narrowly based. It's particularly focused around the external sector, the farming sector, where conditions are pretty good, and I've got a bit more on that in a minute. But it's also quite focused on the recovery of tourism as well. That New Zealand dollar's down a bit. We've actually seen a bit of a recovery in the tourism towards pre-COVID levels. And the other thing is that those lower interest rates are increasingly supporting bits of the economy that are most sensitive to those things. This is a sort of like another picture to illustrate just how kind of patchy the recovery is at the moment. Because quite often when I'm out there giving presentations, people will say, "Oh, Kelly, what are you talking about? There's no recovery here." No, I don't see it. And certainly if you're in Auckland and Wellington, I can understand your perspective. Most firms would sort of agree to you that what has happened in the last 6 months is that expectations for the future have become a lot more positive, but in the here and now, trading activity has been fairly flat. And indeed, this chart shows, the blue line is kind of expectations for the future. The red line is what's actually happened to you in the last 3 months. And we've actually got one of the bigger gaps between those two things that we have seen for a while. We're looking forward to the data in the next few weeks, which should hopefully see that close up a bit. Consumer confidence is on a improving trend, but it is quite choppy. Pretty much there's a decent correlation with interest rates and consumer confidence. It started rising from about the middle of last year when Adrian Orr started to get stuck into cutting interest rates. Had a couple of quarters of decent rises, bit of a tick back in the last few months. People seeing a few scary stories in the newspaper about tariffs and trade wars and things, which is, I think, probably filtered through into the minds of consumers at the moment. But I think the underlying picture you should take from that is that things are actually getting better in the consumer space. And one area where you can particularly see the improvement is in that tourism sector. Now, it looks like from the statistics that spending of New Zealanders is still actually pretty flat right now. But where the real growth has been isn't been in the expenditure of tourists coming into the country. So when Stats NZ breaks that down, so you can see, that horrific COVID period there where tourism revenue collapsed basically through that period. Now we're in that period of improvement, and particularly in the last few months or so, we've seen that foreign spending improve. We've got lots more visitors from Australia and US in particular coming through the statistics, and it wouldn't surprise me if the improvement in spend per traveller may be correlated to the fact that you do have those Americans in town who tend to spend a bit more. That's really supported the parts of the economy which are most leveraged to that. So maybe not so much Auckland and Wellington, but absolutely down in the lower South Island where, you know, the feedback I get from Queenstown, for example, is pretty positive, Christchurch as well. So what's the reasons for optimism about the future? I mean, we think basically instead of having negative growth last year, we're going to get about 2.6% growth this year, perhaps something close to 3% next year. So what's the drivers for that? Well, one, inflation has actually come off a bit, so the Reserve Bank has been able to cut rates. And those lower interest rates are going to start filtering through to household budgets pretty soon now. This colourful looking graph here gives you a picture of how quickly a lot of the mortgages, fixed rate mortgages that people have are going to reprice. And what it tells you is that the quite significant fall in mortgage rates that we've seen in the last 6 months is going to give over, you know, almost 60% of households are going to have the opportunity to move on to a lower interest rate as they go through the next 6 months. Indeed, you know, Kiwis have actually been pretty smart in the last couple of years. They didn't really roll over their maturing long-term fixed rate for a longer term. They figured that maybe interest rates wouldn't stay up as high as they were a year ago. They've been basically right. They've been sitting there short. They're probably getting closer to the point now where they might move into something like a 2-year rate. If you want to kind of quantify how much I'm talking about here, this chart here gives you an idea about how much the difference in interest rate is that you can get now compared to various times in the past. And I like to look at the one that's second from the left there, which is the 1-year rate, which is I think is a reasonable benchmark for where a lot of Kiwi households tend to be when they're doing their mortgage. And you can see there that a year ago you would have been paying 7.25%, but now you'll get 5.25%. Maybe even a bit lower if you drive a hard bargain. So that's like 200 points lower, which translates to quite a bit of extra income in the back pocket if you think about it from a monthly perspective. You know, for the average mortgage, that's probably close to $400 a month. If you're a new home borrower where your mortgage is a bit larger, it might be closer to $650. So that's one reason why you should be expecting to see consumer spending start to pick up as those rate cuts kind of like go through. The other thing that it impacts is through the housing market. The one thing is death, taxes, and New Zealanders buy houses when interest rates fall. They're kind of like 3 laws of economics in New Zealand. And what you can generally see in the housing statistics is that there is an improving tone in the housing market after it being fairly flat last year. Some of the forward indicators of activity in the mortgage market pretty strong right now. And what tends to happen in New Zealand is that when house prices start rising again, the consumer and residential investment, business investment eventually follow. So we would say that house prices this year probably go up around about 6.5%, there or thereabouts, which is more or less a sort of post-COVID, post-GFC average type level of inflation, as those lower mortgage rates flow through into house prices. So the other thing that's going on out there is that we've actually had a really good year for commodity prices. Not very important, I think, if you live in Wellington or Auckland, but actually for most of the rest of the country, it's mattered quite a lot. Dairy prices in particular, very high at the moment. So if you've got customers out there in the parts of the country that leverage to that, they're probably smiling right now. We're forecasting that Fonterra will end at $10.30 when they get their final payout together for this season. And our preliminary estimate for next year is that it'll be another $10. There's actually been a happy coincidence of events for most of the primary sector in the last year. World prices have been quite well supported. The exchange rate's been lower, which has helped juice those returns. Costs have actually been under much better control, not least because interest rates have been falling. And the other thing is the weather's been fantastic as well. So actual production across a lot of the primary sector has actually been really good. So good prices, lots of stuff to sell. That means a bit more money in the back pocket, potentially for a holiday to Bali. Getting outside dairy, I mean, it's actually fairly uniform across most of the sectors. The only thing I'd say is that dairy has been the poster child here. The beef markets are pretty strong. The lamb markets have finally got off the floor and started to improve. You know, 9 months ago when I was being rung up for interviews, people would be asking me about, oh, it's terrible in the sheep and beef sector. Haven't seen conditions as bad since the 1980s, which was actually kind of true at the time. No one wants to hear about those sort of stories anymore because it's just not really true. It's not boom times, but it's certainly a lot better than it was. And even in the sort of horticultural sector, that's another sector where they got a big hit during the cyclones a wee while ago. And now they've recovered from that and the prices have improved, so there's pretty good income levels there, thinking about if you're looking in the Bay of Plenty down in Central Otago as well. So the baseline view here is that we are going to get recovery. It's going to gather pace through 2025. We should hit trend growth second half of this year. We actually, as I mentioned, had a pleasant surprise about how strong growth was in the fourth quarter of last year. Data in the first quarter of this year looks fairly decent as well. So there's increasing confidence that that more optimistic view we have is something that is going to pan out as we go through the year. We just have to recognise that there are lags in the process here. You know, interest rates only started to get cut back in August. It usually takes a good year to 18 months before you start seeing the full impact. So thinking about lags, you know, the one thing that I think most people would bitch about right now is that the labour market is still actually pretty weak. The unemployment rate is likely still rising and will continue to rise until the middle of the year because it always does lag developments in the broader economy. That means that the unemployment rate looks set to remain relatively high for the next year or two. At least the next year. Means wage growth should continue to slow, which would be quite good for costs in the business. But it is a bit of a headwind that consumers are going to have to continue to deal with for a while yet. Inflation is in generally a much better place from the perspective of most households. 2 point something is a heck of a lot better than 5, 6 or 7 point something. So that's quite good. For the Reserve Bank though, they're actually pretty happy that they've at least got it back within 1 to 3% now. But if you look at the forecasts that most have, you can see that we don't really expect the inflation rate to fall very much further from here. And indeed, with the fall in the exchange rate, rising commodity prices, that means that there's probably going to be a tick up in inflation through the balance of this year. It's one of those factors, I think, that means that you've got good reason to believe that the big interest rate cutting cycle that we've seen so far is probably getting very close to its end unless that volcano erupts and derails this whole recovery. So interest rates, pretty close to their bottoms. We've got a couple of more rate cuts in the next couple of months, and then I think that'll be about it. Means longer term interest rates pretty close to where they're going to get to, which means your longer term mortgage rate, you know, your 1, 2, 3 year mortgage rate is pretty much as good as it's going to get, unless something bad happens. And I always tell people that if something bad happens, the last thing you're going to care about is the last 50 basis points on your mortgage rate, because you'll be thinking about your job or your business. Tariff policy, the uncertainty, that volcano. A lot of words on this page, but I would say that there's good and bad news here. The bad news is that the US is our second biggest trading partner, so obviously we have a reasonable exposure to whatever goes on in the next few months or so. The good news is that we're actually infinitesimally small compared to from the US perspective. So it's really unlikely, I think, that Donald Trump is sitting in his office right now going, I need to get those Kiwis. Right? He's not thinking, he doesn't be shocked if he knows where we are, to be honest with you. Doesn't mean to say that we can't get a tariff dumped on us because they maybe impose something on everybody. But in this game, at least a good chunk of what happens to you depends on how you come off relative to everyone else. And in that score, I don't have a particular reason for pessimism there. And the thing I would also say is that, I've told you that positive story about how commodity prices have been the last year or so. Well, at least we're getting this shock starting from a good starting point, as opposed from it being at the bottom of the cycle. The sorts of markets that we're particularly exposed to are in the meat, the dairy, and in the wine sector. And if I had to worry about the sector that's probably the biggest problem, be the wine industry. We're the third biggest exporter of wine to the United States. There aren't very many other places to send it if we're not sending it there. So with that, I will end. I think it's a cautiously optimistic view, depending a little bit on what happens outside of our shores.